Good evening, everybody. Welcome back. It's been a busy month since we last spoke. Just even in the last few hours, we've had some big moves. The dollar particularly has had an interesting move recently. So, with commodities sort of priced in dollars, I just want to sort of go over some of these commodity stories, if you like. So realistically, obviously, we produced this presentation late yesterday and early this morning. We've had some big moves since then, so bear with us on that. But overall, we want to tell you where we are and what's going on with commodities at the moment, because they actually are getting quite interesting at the moment. So, commodities have had a rough ride. The dollar's been higher. We've had this drought or global health warning, if you like. So the health of the global economy has been weak. China has been disappointing. And so the commodities work with a supply and demand dynamic, and the demand side of that has been poor to date, which has seen the likes of copper that you can see on the chart in front of you drift lower over time. A few spikes, but that trend low is quite clear to see. Obviously, July the 10th was when that was last updated. We have seen a spike back up towards the highs of that sort of band that you can see, that channel downtrend. So, commodities are at a very interesting stage at the moment. I think it's really interesting to see where we go from here, because in the face of potential higher interest rates from Western central banks, we've got problems that, yields are higher, the dollar could do well. But this race to raise rates is not just a US phenomenon. And so therefore it's about who's doing what, and this central banks moving out of lockstep. So you can see the New Zealand, the RBNZ, very strong, very aggressive in their fight against rates, against inflation, with rates up at 5.5%. They're now pausing. The US 500 basis points of hiking so far. Are they going to pause? It looks like they got maybe another hike in them as well, and certainly hikes to come elsewhere. We saw Canada up again today, and across the face of that, higher yields are not particularly good for commodities, but it depends a lot on what the dollar does and where that demand structure is going to go. So we've got a lack of substantial fresh government stimulus in China, and I think you cannot trade commodities without having a view on China. China's economy is looking weak, but it does look as though they're prepared to sort of look at stimulating the economy in certain sectors. I don't think we're going to get this bazooka effect that we've had in the past, where they throw billions and billions at this to support the economy. They've got too much debt in their economy to do that, and so therefore there's a concern that whilst China's inflation rate, as you can see on the chart here, falling back down towards zero, suggests that the domestic economy is not that strong still, and so there may be this still delay or lack of demand coming from China, where many people expected China to come in and save the global economy with a big push up in support for demand for commodities. It's not happening at the moment. So I think, it's very difficult to talk about commodities without mentioning the dollar or China and the demand side of the dynamics. But last week, we saw a very good rally in oil. And I think things may be starting to change in some of these commodity markets at the moment. We saw oil rally about 5% last week. It's up again today. It was up again on Monday. Saudi Arabia has extended their million barrel per day cut into August. And that chart there showed you that oil is still looking pretty solid now. So WTI, that's the West Texas index, poised for a second weekly gain as US stockpiles fall. So the inventory for oil in the US is actually falling. So demand could actually start to swallow supply. And I think we're now moving from this demand dynamic that may be bringing us to need to sort of focus more on the supply dynamics of how commodities work, particularly with the oil, but also with copper and some other things like iron ore and these things as well on a macro basis. So oil reserves, as you can see here in the US, falling steeply. So it looks to me like they're going to have to start replenishing that. This is their emergency crude stockpiles that they have. It's called the SPR. And, that they really are running quite low. So this could also support oil. So again, there is a potential story here that some of these commodities are starting to move and possibly reverse. So the US has brought forward this planned strategic petroleum reserve buying. So that could be ongoing. But the question, is there a potential base forming below 70 as these factors hit at the same time? I think there is a good story for that. The chart that you can see in front of you suggests that we're moving off these lows. We haven't broken those recent lows either. And with the extra move we've had up today, with another 1% higher, I believe, when I last looked, oil is actually looking like it's building a base here. If we take out those highs that we saw on June 4th, which it looks like we're doing now, then we could be actually looking at some blue sky above and a test higher. And I think the market may be a little bit short here as well. So for me, commodities are just starting to suggest that we've got a bit of a change coming. And to be honest, the fundamental dynamics of all this suggest supporting that view as well. Natural gas has had a strong open to this week, up 6%. Traders are bullish. Sentiment remains. That bullish sentiment remains. The only thing is that it looks like Europe is beginning to hot up weather-wise. Some people talking about a heat wave all the way into autumn. Is that going to delay the demand for winter natural gas? I don't know. But at the moment, we do seem to be, we had that spike low that you can see on July the 7th. We've now rallied from that. Again, the dollar's got a less of an impact in natural gas than it does in other commodities, but it's a demand thing that's going to drive this. So natural gas slightly different to everything else, but this hotter weather and these seasonal forecasts across the US and Europe are a concern for heating needs. But there again, obviously air conditioning could be sort of taking up some of the slack on this as well. But it's going to be difficult. Increased output being met by extra demand from Asia. Natural gas is more in balance, I think, than some other commodities. But, there's expectations that higher gas extraction still isn't enough to meet rising demand. That remains to be seen. But I do think there's, we've hit some pretty big lows in natural gas. And I think the demand is going to pick up into the winter. We may have to wait for that. But I do think there are some signs that demand could outpace supply going into the autumn. So natural gas daily chart, if we look here, it has got a very solid high in place, this February the 3rd high. But if we take that out, then I think we could have quite a big jump higher from there. And the support seems pretty clear. Where that line is drawn, that's an underlying trend support. So is the Feb high a significant challenge topside? It is a significant challenge. But just be careful, if it breaks, that could be a game changer for natural gas. So talking about things that are changing, gold failed to close below its key technical support. If you look at this chart here, you can see that solid support. It's a 62% retracement of the highs back to the lows there that we saw on that move. It held very well. Now, the weaker dollar, and we've seen the dollar quite a bit weaker today, has helped gold push quite substantially higher. So, we're now looking back up at these sort of 1938, 1940 levels for the next resistance. And to be honest, I think, gold may also be putting a bit of a base in here. There is a freeze on Russian assets has increased gold demand. Significant portion of central banks continued to buy gold. They seem to be stockpiling that for some reason. China's been very active. Some of the other central banks as well. Possibly an alternative to a shaky dollar. This freezing of assets, of Russian assets in the US, has frightened a few people. So I think quite a few central banks that are not so friendly towards the US are actually buying gold, and I think that's held it pretty well bid. Hedge funds have cut dollar longs. So the market is now getting short dollars. I think that obviously gold is priced in dollars, so that is supportive for gold as well. So these hedge funds, they've cut longs. I'm not sure they're massively short dollars yet, but again, we had a big move today. I think dollar index is down close to 2% over the last week or two. That's a big move for the index. So gold continues to attract on dips. And I think whilst uncertainties persist around Ukraine and the risk with some of the smaller lenders around the world, then I think gold has still got some value. But I think at the moment the dollar's playing a dominant role as those other issues are slightly on the back burner. I mean, US lending conditions, we're actually seeing lending commercial and industrial loans to small and firms picking up, but starting to roll over possibly. It's difficult to really see where gold's going to get enough impetus to make the highs that we've seen recently. But, with gold actually reactive to systemic risk, if we look at this chart on the right, the S&P estimates corporate default rates are rising and going to rise into 2024. That's the sort of thing that sees gold do well. So keep an eye on this sort of thing. It's the systemic risk issues that really gets gold going. And when it's quiet, the dollar has a bit more of an influence, as we're seeing today. But if some of these stories start to sort of build, then gold could actually start moving back towards the high. So just be careful of gold and what's driving it at the moment. And these corporate default rates, with higher rates, are a bit of a concern. So everybody's looking at that for the next move in gold.